Good afternoon. My name is Bahman, and this is Turnaround, a weekly show to bring different aspects of the businesses and organization in regards to the issues that and challenges they are facing. My colleague John Hardy is with me, and you are just watching a Turnaround duo to provide you with some information. Today, it is our third show, and we are lucky to have a guest here. And I will, without any further ado, I want to ask Joe to introduce himself. Joe, can you just tell us a little bit about yourself?
My name is Joe Barbieri, and also known as Joe the Investor. And my background's in investments, financial services. And what else would you like to know?
Well, it is all your life. It is just an investor.
Well, the working life, most of it.
Mostly like name, rank, and serial number. That's all you're giving.
I can go on about a lot of stuff.
This is going to be a tough interview.
No, actually, Joe, you remind me of those capture in the mission. Okay, that is that is, and I don't give you. But first of all, thank you. It was just a joke. It's just breaking the ice. This first time I met you. But when you talk about investment, what type of specific investment are you talking about? What is specific? Is it insurance? It is the stock market? Is it banking system? What business exactly?
When I started, I guess it was institutional investment, and they invested in pretty well everything: real estate, stock markets, bond markets.
So overseas. You use your own capital for this investment, or you use someone?
This is other people's capital.
Some other people's capital.
I was analyzing the situations and.
Can you run us just for this without divulging any name, but a sample of what you do, for instance, for a client that you have done, let's say, last 6 months or 1 year? Just one sample. A client comes to you, you go to client, and how it works. So
right now, I'm what's called a fee-only financial planner. So I do financial planning for individuals, and so that would look like a person comes to me and says, I need a plan.
Okay.
I don't know what to do with my money, or I'm not happy with how it's going, or I need advice on this or that. And it ranges from investments, taxes, insurance I don't get into too much, but I can get into it. Owning a house or not, vacation properties, pretty well anything that comes up in somebody's life. Starting a business comes up. That's what I do today. What I did in the industry was more, so the example I can give you is a pension fund. A pension fund is a pool of money taken from the employees who contribute to the pension fund. That money sits in an account and they invest it and then give it to the retirees later on. So it tends to be, this was a large pension fund in the billions.
Is it a private sector, or is it like public sector, like Crown corporations, or?
This was a public sector, but it's the same idea.
Okay.
It's pretty much identical to a private fund. They take the money and parse it into buckets. So a Canadian market had some, the US had some, international had some. Bonds had some, cash.
This is like an investment that individual go to the bank and get RRSP or something like that. They choose what kind of.
It's like that, but it's a big scale.
Bigger scale.
And they put more effort into it.
Was there any institution that you were working? Right now, you're working privately. That's correct.
Mm-hmm.
Before, how long you're doing that for private?
5 years.
5 years. Before 5 years, were you part of a larger organization?
Mm-hmm.
I don't know if you are allowed to say the name, but how big was that?
In terms of people?
Yeah, in terms of the fund, in terms of what you were managing.
About $12 billion.
$12 billion. Mm-hmm. And why you moved from that organization to the private sector yourself? Was it just you wanted freedom, or it was some other reasons?
Oh, there's a few reasons.
Well, like so lots.
I think
let's explore some of those that you feel comfortable to talk about. let's explore some of those reasons.
So I guess if I back up to the industry,
Okay.
so the industry is based on sales, the investment industry, and that's for institutions, individuals, small businesses, whatever. When you go to invest money with someone, the first thing they ask is, how much do you have? Because if you don't have very much, you go into the mutual fund bucket. If you have $500,000 or thereabout, you get to the high net worth bucket. And if you get into the millions, you get into the private, you have time to talk to the advisor bucket. And if you're in an institution, you get to the institutional bucket,
Which is the highest
where you get a professional consultant, a company, and management companies that you can pick from, because it's now hundreds of millions, billions of dollars. The idea is the same, but it's based on percentage of what you're giving them. That's where all the money is made with investing. Now, the problem with it is if you don't have the money, you don't get the service, and how much money will correlate to how much service. So whether the decision's good or not may or may not happen. There are good advisors, there are good setups where everyone gets the benefit, but sometimes there isn't, because the key is how much money is going to get made.
So the primary objective of this consultant, based on what you just described, is how much money they can make for themselves first, and then based on that they go to the level they are. Like it is, you said it is below 100,000 or 500,000 or $1 million or $100 million.
So for example, you would think, so if you yourself go to an institution and say, I have $200,000, I want to have a retirement goal of whatever, $1 million, and I want to have this income and I want to have this lifestyle. Okay. When they're advising you, they're saying, how much commission am I going to get from this person? So there's multiple objectives. One, I want to keep the client. Two, I want to make some money. Three, I want to please the institution.
The institution they're working
for, because you have to work for an
Yes.
institution to have access to the product. That's the rule. You cannot do it without, you can't sell anything
So there is
without,
a certain amount of the quota and the requirement from
and
the
company,
institution.
and the company will give you a
Okay.
quota that says if you don't sell $8 million of whatever, you're fired. So there's multiple objectives that might conflict with pretty well all the advisors, because unless you're selling a lot of stuff, they're going to come to you and say, what's your target? 10 million? You only got 5? It's not good, you know. And then you're going to be pushing towards, I have to sell to survive. Especially at the beginning. The first 3 years is all about survival, because that's your income. They do get a salary, but a lot of them have commission, and if you don't sell, no commission.
And no salary income probably.
Or you're out.
Yeah.
Ultimately.
And if you don't
if
do
you
it-
don't meet your quotas, ultimately
You
you're
wanted
out.
to ask something, I believe.
Well, just thinking, also, is there a different percentage that, let's just say, if I'm giving you, you're the advisor, I'm coming to you, let's just say it's $500,000. What are the kinds of choices that you can put my money into? Let's say it would be mutual funds versus what? What are the kind of, what's on the menu typically?
Okay, so choices also vary. So if you come with $1,000, you'll have the retail fund. That's it.
That's your choice.
If you want a hedge fund, they'll say, get out. It's not worth it. You want to buy real estate? Get out. You want to buy commodities? Get out. It's just not going to happen. The one trade alone, the commission will be $1,000, and so that's very limited. You get to 100,000, you'll get some more funds, but still fairly limited. When you get to $500,000, now they get into, okay, you can do hedge funds now. You can do certain specialty funds. Every company has their own minimum.
And what is a hedge fund? What does that mean for the consumer? Because we hear that name a lot.
You hear it a lot.
And it's also, I know it's bandied about and sort of bent, but actually I'd like to ask two questions. One, what is the hedge fund supposed to be? And what is it in practice?
Okay, so the original hedge fund, so hedging,
Yes.
if you heard the word hedging your bets,
Yeah.
it means you're betting both sides. There's 5 horses in a race, I'm going to bet on all 5. So whoever wins, are going to get something out of it. That's called hedging your bets.
Mhm.
What they do in the investment world is they go long and they go short. Long means you buy and you want to sell at a higher price. Short is you sell and buy it back at a lower price. So when the market goes down, you make
gain.
money on the short.
And
When
these are
it
called
goes
spreads?
up, spread is the difference between two prices, and you can play that too, but that gets more convoluted.
Right,
So what these people do is they go long. So say the oil sector,
Yeah.
I don't know where it's going to go, so I'll buy 5 oil companies long, just like you would just,
Yeah.
you own shares in 5 companies. And you go short the oil futures, as an example. If the oil price goes down, I make money here, but I lose money there. If the shares go up, I make money here and I lose money there.
But
And
so
when I offset, I get.
where's the play? Because if I'm just, it's almost like, I'm
Okay,
betting
so
on, it's like heads and
what's the
tails and I'm
point?
betting on both. What's the point? So there's got to be some.
So the
yeah.
skill is you're hoping one's going to go up more than the other. One
Who's
will
the
move
skills?
more.
The
person
advisor,
running the hedge
advisor,
fund.
Okay.
So that he's got a directional bias of some kind. For instance, in the case of oil, it's that oil, I'm betting the oil will go up. So he's going to buy more oil and sell less,
That's one way to do it.
for instance. Now, but in practice, from what I understand, a lot of these things are quasi-hedges. They're not true hedges. A lot of these things which are billed as hedge funds were not, in fact, classical hedge funds. And can you speak to that? In the sense that, they were, in other words, generating returns of 18, 20%. Like, how can a hedge fund generate those kinds of returns?
Well, if you amplify, you can get whatever you want. So let's say treasury bills, pretty blah. They'll go up 2% a year, 1% a year. Big deal. What you can do is you buy $1 billion of treasury bills, because they tend to be big lots.
Yeah.
But you don't pay in cash. You borrow. And you borrow a lot. So you put 10% of your own money, borrow the rest. Because it's not your own money, so how the calculation goes is the return is based on what you put in. Borrowed money is an expense. So if day one comes, you put 10 million into these treasury bills, they go up 1%, and then you get out. Say it happens very, very quickly. Some news release comes, we're going to raise interest rates, or we're going to lower interest rates, all the prices go up, and you get out. So it only moved up 1%. Okay, well, so what? But
Times 10.
But I borrowed 10 times, so I make 10 times. Now you have 10%. So now you're saying you made 10% on a treasury bill. How? Because you amped up. You took a small thing and you juiced it up with debt.
Exactly. But isn't the trick here that on the one hand, hedge has the connotation of low risk, but margin
Does not.
is in fact high risk. So you now have something which is not a low risk fund in the end at all.
Well, it might
It's
not
hedge,
be.
but it's not hedge in the sense of being, hedging risk. It's hedge in the fact that it's sort of a financial hedge. And I think isn't that where a lot of the misunderstanding is? People had the misimpression that I'm betting on a hedge fund, which means basically it's secure and this return's locked in. Isn't that the impression that a lot of people had?
I think, well, I think some people believe that. For example, in the futures market, you'll see this. They'll have speculators and they'll have hedgers. And there's different rules for them. If you're speculating, it means you're going to bet one way or the other. And because of the huge margin that's always in those markets, they only give you like they give you a deposit margin, which is tiny, and you can pretty much play with debt.
So
But
it's like
if you
99%
lose,
margin. Yeah.
something like that, and if you lose, you're wiped out. So they screen you, they do a royal screen on you, they make sure you have lots of backup, lots of funds in the account. In case you do lose, you can pay up. So there's very strict rules to start playing. But the hedgers, the rules are relaxed because they have to offset some of these bets that they're making. And so it's very different. And so the classic hedge fund has that offset, but after that it became, if you have the ability to do the hedging, then you're a hedge fund. It doesn't mean you have to do it. You're just allowed to do it.
And so they could take advantage of essentially that preferred position in the market, or rather, vis-a-vis the amount of lever or capital they had to have on hand to support their activities.
I mean, can they interchange the capital that they have between the hedge fund
so
and other
they start to act as
investment?
speculators.
Yeah.
So that here they are, on the one hand, being declared to be hedging, but on the other hand, if they then start to actually play as speculators,
then
start to
you're
behave
at
that way,
risk.
then they're at risk, and then they're taking advantage of essentially their preferred position there.
Well, now in defense of that,
Yeah.
and I think it's still the case, the people that were allowed to buy those had to be rich, sophisticated, educated in it. There was a lot of disclaimers that came to them. If you buy this, there's all these risks. There's pages and pages of risks. Now, it gets gray now after that. So as the investor, some people are rich and they are sophisticated and they know how it works and they're willing to take the loss because they know how it goes and they just don't have time to do it themselves. And yeah, he made a bet on oil, he lost. Oh well, that's how it goes. But there are some who buy this stuff and don't know. And yeah, it could start as a classic hedge and then it morphs into, well, we believe. And again, you said, well, if I'm always absolutely hedging, what's the use? I'm just going to get zero all the time. It's not worth it. So every once in a while, when I think a sure thing is going to come along, I'm going to lean towards, after a market crash,
At that moment,
towards,
you're becoming a speculator.
and if you're
in that
wrong,
transaction.
then you have a problem.
Exactly.
And if you're right, you're the hero.
And
You're
as an
right
advisor, you
100%.
make that decision to shift when that's
Well, the man-
or as a customer, they do that.
The manager of the fund
Fund.
will do this stuff. The advisor's looking at
And
it.
so now here becomes the question also is when the advisors were getting people into these funds, were they apprising them of the level of risk that was really there? And two, I guess there's a couple of questions. One, did the advisors even know really the internal workings of these hedge funds that they were putting money into? This kind of, for instance, activity. The first question. And the second question would be, and if they did know, was this properly passed on to the clients? In terms of, bring them up to speed on the true level of risk.
Well, this might.
I would say partially. Well, okay. If the whole world had 100 advisors in it, maybe 20 of them knew how this stuff worked. Because
so first of all, it was just the technical difficulty of it, or the lack of training of the advisors, or what was the cause of that?
I mean, so the financial advisor terminology is very vague. So if you did the CSC and you work in a bank, you're an advisor. If you did an MBA, a CFA, traded your own money for 50 years, you're also an advisor. It can range that much. And so there's people that just have the basic idea and they're in the institution, but they're like, well, the institution is, if there's an issue, I can always ask somebody else for help.
So that they're going on that assumption.
But the drawback is when the person's in front of you and they have a choice to buy this, can you personally explain what's going on? And maybe not.
Now getting back to what you were talking about in terms of quotas and in terms of returns, would these higher risk instruments offer the advisors higher premiums than, let's just say, the lower risk instruments?
As a rule, I'd say yes.
So now we've got a natural bias.
So you're seeing what the incentive is now.
Exactly. So this is where we're sort of backing into almost really the systemic issue here.
Which is
the fact that the very motivation, in other words, all the pressures, various systemic pressures that you're describing, that are focusing on that single point being the advisor. So where the rubber hits the road is where the advisor is speaking to the client, right?
Mm-hmm.
At that point, there's a bias towards risk. There's a bias towards getting the client to accept more risk, or at least in some ways cloak the risk, correct? Because obviously a client is risk averse. If they're fully apprised of risk, they're going to be less inclined to.
I'd say it's true for a lot of people that they'd rather not. Well, this brings up another point about the systemic part. And you can see this in the macro level. The interest rate is 0. GICs are paying 1%. Bonds are paying 2%. These used to be the go-to investments for most people because they used to pay 5%, 7%, 8%. You could live off of that. You didn't need any of this other stuff. Now the rates have been down so long, people are running out of income. And the customer comes, I want that 5% I used to get because I can't pay my bills anymore. These are typically retirees.
But I want to retain my capital.
And I want to retain my capital because if I don't, it'll eventually erode into nothing and I'm going to live to 100 now instead of 65 and I'm going to run out of money, and that whole fear is out there. So they come with that. So as an advisor, you're like, cash is 0, GICs is 1, bonds are 2. These are the low risk ideas. Then you get to
mutual fund.
And funds can be anything. You could have cash, bonds, stock, and all across the map.
An ideal solution would have been to actually push as one of the products adventure tours for the seniors, because that way at least you lose a certain percentage, and so that eventually as it works back into the system, you balance out the risk.
Which product you're talking about? Hedges?
No, adventure tours for seniors, because a certain number of them will just natural attrition. You basically
now, Joe, based on years back, I used to be for a short period of time sell insurance products. I'm talking about 25 years ago or something. And the same principle that you just described was applicable at that time. And I'm pretty sure apparently nothing has changed. A lot of things has happened, nothing changed.
Just new products.
Yes, really. Like it was Glenn Fry song, Man of the Street. I came back, lots of things happened, nothing has changed. So in last 25 years, apparently the system is the same. And the pressure was, your quote, you selling insurance, I give you all of the premium of the 1 year up front, because then I have that customer for lifetime, then you get the residual or whatever. And if the customer, of course, cancel, you have to draw back and you have to pay back. But the pressure of the manager to us usually was, who did you see? How many people did you see? How many did you close? How many? You see, all was is like a form of the sales KPI system that you say, okay, it is your victory log. I did 50 calls per day. I did 5 appointments per week, and I did 1 close or 2 close a week. What you just described is the same way. The difference was if we did not sell, because they did not pay any salary to us, they just hang us to do the free advertising for them for a while to get rid of us. But if they pay salary, apparently I believe the pressure is much higher, the way that you just described. Now, based on what John said, when you meet a client as an advisor and you have a pressure from one side, and the client is asking you or telling you that I can't pay my bills, it pays 0 or 1%, I want to retain my principal and I want to make 5%. At that moment, as an individual, as a human being, are you inclined to go to your interest, or are you really thinking of the client at that time? Or if
Not
it
you
well,
personally.
not
but
not
yeah,
you personally, by the
The
way.
average person?
People,
Well,
people,
Yeah,
people
apparently-
like you.
Well, the average person is
Yeah.
going to look out for themselves.
Ultimately, actually, I
you
think
know-
I think another way to look at this is really what is path of least resistance? Because if you've got 100 people, we can't expect everyone to be noble. What's the path of least resistance in this at
Yeah,
that
yeah,
moment,
yeah,
right?
yeah.
Under those pressures. So let's just say let's describe the pressures, the situation. So you've got the client who on the one hand wants capital maintenance and he wants a high return, which is 5% nowadays would be considered a premium return, correct? Like in terms of
Yeah,
In
it's-
comparison by the
it's a
GIC.
medium risk return. That's not low risk, is it?
Medium risk, I would say.
Exactly.
Yeah.
But they're a low risk category individual.
They,
Right. So here you've got a low risk category individual who essentially is now looking at, or it would be very easy for that person to be talked into a medium risk investment because that's what they're inclined to go. So you've got that direction, that vector, right? So then we've got another vector, which is the line of force on the advisor, which is really in the same direction, correct? In the sense of assisting him with his affliction.
Yeah.
So so that in this sense, in a way, it's like the pusher become like you become the pusher of risk and the enabler
you could say that.
in that situation.
And
yeah.
the point is
I
it
mean,
a common
the advisor.
practice in your industry
To do that,
to do that? Yeah.
I would say so, yeah. It's, and so adding to that,
Right?
that 5% return also brings a commission with it.
A better
Of-
commission.
So if you have this,
So there's a confluence of objectives.
it's all
Yeah.
pointing towards high. Everything's going to be higher. Higher expected return, higher expected risk, higher expected fee, higher complexity. A GIC is nice and easy. Sign this, you get 3% a year, 1% a year, and there's nothing more to say. There's no trading, there's no
And don't
price
you al-
doesn't change.
And you also
Nothing.
have another problem, which is competing advisors from other companies. Because if let's say you're offering a low, something very conservative, which is really prudent, whereas the fellow across the street
I can get you 6.
can get you 6,
They
etc.
don't tell you how.
Precisely,
They
and he'll
say that I
say,
can
but
get
it's
you
a good
6.
thing, I've got friends I know, blah, blah, blah. And then, of course, where are they inclined to go? And then if it
higher
works out, then he's a genius.
Yeah, well, I've seen both
Exactly.
ends of that, where they've picked with high yield bonds it happened,
Yeah,
dividend stocks it happened, different sectors it's happened, timing in the whole market. If you came in 2009 and bought a bunch of real estate in Florida, you'd be a genius because it all went up 100% since then.
so isn't this...
If you came in 2006 and tried that, you're still underwater, and you might be underwater for a long, long time because you didn't read the situation.
Yeah.
But if you're the customer going in and you don't know anything about Florida, the advisor does because you live in Saskatoon,
That's right.
and they're saying, "Wow, Florida's hot. Everybody's going to Florida. Buy
Yeah.
this rental REIT. In Florida you can get whatever. It's been going up 10% a year, but they don't realize underneath it is this debt inflation, this subprime thing that was pushing everything up, which burst, and then everything went down. And then you had this rock bottom in 2009, houses for $10,000, etc. And then since then, they've slowly, now those same houses are $50,000 to $100,000, which is a nice return, but
for those who bought it in 2006,
depending on when you got
was
in,
not-
so you could have the genius, or you could have the loser on the same investment,
E-
based on a year's difference.
Exactly. and
Because and the customer doesn't know, unless you know these markets, you won't know if it's too hot or too cold, or if it crashed, if it didn't, because a lot of people don't read on all
And
this.
often those advisors themselves don't know, correct?
Sometimes they don't know because
They're not specific experts in those markets. So in a sense, isn't the business on the whole a kind of risk, instead of risk management, risk masking business?
well, risk encouraging in some
Yeah.
ways
Risk encourage.
Yeah.
to a point.
Let me ask you, say, just from different angle. When you have, like any industry, like even if you go to a group of doctors, you have a good doctor, you have incompetent doctor, you have mediocre doctor.
Well, we're not supposed to admit to having incompetent
And you
doctors
have
within the
really bad
system.
doctors.
Well, we have
But
plenty
anyway.
of them. Believe me, we have plenty of them. Personally, first-hand experience.
Just so long as you don't get specific, it's okay.
Well, no,
we
no,
can
no.
deal with the
No, no,
notion that there might be out there
after,
somewhere.
after the show, I will explain to
Statistically.
you.
Every industry's done that. Yeah.
But the difference in the technical industries or skilled industry or professional industries usually comes back to the level of the time, level of the knowledge, amount of the time those individuals spend to update themselves in their industry or in their field. When it comes to the investor advisors, what kind of the tools do they have? Because part of that is the speculations, and many of the criteria is beyond your control. You don't have any control about, let's say, 9/11. You don't have the control about 2006. But no matter how much of the knowledgeable person you are,
You still can
it's
lose.
still. I mean, it's not like a doctor could screw up based on earthquake in middle of the operation, which is very rare. What it happened, I can understand. But in your industry, one event, let's say Paris event that happened a couple of nights ago, it could affect the market drastically. And no matter how what is your amount of the knowledge you have, how you guys prepare yourself in general to deal with those
that?
things?
Well, okay.
Because it's not your money, it's the client's money.
Well, yeah. Well, it's always the clients. You know, when you go to the doctor,
Yeah.
it's the patients that are supposed to count. The mechanic, it's the
Yeah,
customer's
the
car.
customer, of
The
course.
accountant,
Yeah.
you know, blah, blah, blah. You can say that for everybody. So it's always somebody else's stuff. Now, the industry does a lot of education. They have courses all the time. They get tested all the time. To keep the license, you got to keep renewing, doing exams all the time. And yeah, there's two kinds of knowledge. There's the knowledge to do the job, and then there's that expert knowledge of, I can predict 9/11, or there's a probability that something's wrong, and I'm going to move my client's money out, and I happen to figure that out. And it's very hard to do that, and most people don't do that. There's the odd one that makes a call, and they become the gurus, and they're on BNN, and it's like, yeah, you know,
I knew
so and so
that,
said this and he predicted that, so let's do what he said. But that's going to be 1 in a million that does that. So like something like Paris, you can't really prepare. You kind of just have to build the safety in, have safety period in your portfolio, so if that comes, you won't lose everything, you'll be still in the game. But the education won't help you with that.
Okay.
That's just prudent practice.
Is there now coming back to the industry? You said you were with one big institution, and then you moved to the private sector, and a little bit we get to the technical aspect of the investment. Among those reasons that you just started to describe, was there any reasons regarding the lack of, let's say, I cannot say honesty, but lack of straightforwardness of the certain practices that caused some individual to move out? In your case, at least.
Yeah, well, okay, I'll get into that one now. Back to the other question, the prior question about the education part. I feel a lot of people, well, there are people that know what they're doing, but still follow the mainstream.
Okay.
They know these things may be risky, but because I want to sell and I get a nice commission, I'm going to take a chance and recommend it anyway. There are some that don't know. My boss said that this bond fund rocks, so you should buy this bond fund.
Well, just
they don't
follow.
know that bonds can crash because they haven't studied bonds. But they'll say bonds are relatively safe. The high yield bond is a little bit more than a regular bond, but it's okay, just go ahead and buy it. The high yield market crashes, you lose 30%. What happened? Oh well, I didn't see it coming. And there are people that really don't know, but there's some that do know, and they're weighing it out in their head saying, okay,
What are the odds?
is this client worth
My
taking a
BMW is
chance?
more important.
Do I need this commission? Am I going to get fired? Is my boss going to, I'm not going to make my quota. It all gets balanced, and then you say yes or no. And it could be, if you're a really, really good advisor, have a lot of assets that you manage, you'll probably say, don't buy it. I don't need that. If you're a new advisor, you might say, I really need the commission, so here, roll the dice on this, and I hope it works. So there is that element.
I guess it depends on your lifestyle too. Like in the
Well-
sense that if an advisor's living well and living under the bed, like he's continuously making more good returns, and we tend to live beyond our salaries and we tend to project them forward, which
That
especially
does
people,
happen.
yeah, it does happen too. That also, certainly creates a built-in kind of bias that way, wouldn't it?
Well, so for example, after every crash,
Right.
you'll hear about broker suicides. You'll hear about people leaving the industry,
Yep.
going bankrupt, always after a crash. And what you said hits it. Because leading up to the crash, there's this big boom. So 1987, I first heard about it. The 80s, so 82 was not very good, 81 was not very good. But coming in 83, the market had a big boom up until 87. The brokers at that time were making a lot of money because more assets came in, percentage of the assets, my fees went up. And it went like that, it was exponential. Then 87 came, smash.
It was a quick crash there, wasn't it? There was a
It
quick
was a
correction.
quick crash. By 88 it came back up, but the damage was done because it was severe.
A lot of that money went into the real estate market, I remember at that time.
Yeah,
And the
right,
real
right,
estate
right.
kept
Switched
going
markets,
until
yeah.
1990, and then it left that,
That's right.
and then it shifted again into commodities, whatever. But those brokers in 87, a lot of them jumped out of their office to their death because they lost so much money. They were so used to that lifestyle, they couldn't handle having to go without, and they didn't know whether they would last or not last because you never know. And then after 98 it happened again, 2001 it happened again, 2008 it happened again. Every time there's a big correction, somebody goes beyond their means.
But the interesting thing is
And so this is happening all the time, and I'm sure it's a
Well,
continuous thing.
this sequence is like 7-8 years apart. Is there any
Well, there-
any? I don't want to stop you from the
Well-
original question that about your.
Officially, I don't think there isn't any statistical pattern. I mean, if you look at astrology or whatever, they'll say, yeah, every 7 years there's a.
No, based on
this
the
and that.
dates that you just said, you're right.
But it turns
2001,
out-
2008, 1987, 1990.
Those are all every 7 years.
so
Yes.
it's a mean of 7 years approximately. Like it varies, but I think the average is of these cycles or something like that.
It's been like that the last 30 years, which
So which then tends to lead one that so if you've gone more than 7 years without a correction, like how long has it been since the last correction?
7 years.
2008.
7 years.
So it's 2,000 years, we're at 7 years. So basically that means that at 7 years, if you haven't had one, you should at least start to be looking for one soon, in
Yeah.
a sense. Like in other words, as a prudent advisor.
Yeah.
If you want to at least in the
And-
back of your mind to think, well, there is a possibility here. And a greater than, in other words, statistically now the odds of this happening in the next short period of time have
Are
now
going
really
up.
ramped up. Yeah.
And even that, what this 7-year idea is fairly advanced. A lot of advisors wouldn't even bother entertaining it.
Well, it's not in their interest, is it?
Because how do I make money on a crash?
Because
Unless
they're not
you're
selling
betting
short.
on it.
They're not going short with their clients most of
And
them.
what some of them do is they go into cash. They get defensive.
Yeah.
And that's what I've been doing. I have a big bias on cash, more bias than what the textbooks say, what the average is, for that reason. And you gauge how the person can withstand it and how much time they have, and there's all that personal circumstance. But when you cut through that, if this person can withstand the risk and they don't mind waiting around, they can go into equity and just roll through it. And when it tanks, you say, look, every 7 years it tanks. This is a pattern. Just, you don't need this money. Just hang in.
But this would be for blue chip. Like this would be for solid, like very solid companies who would tend to do this. I mean, you wouldn't do this with penny stocks, obviously.
Well, penny stocks have their own cycles, but they're very, it could be 20 years, it could be 2 years, it
But
could
you're
be
not
10
going to do
years.
this, just buy and hold to the same extent.
Because they tend to change. Because,
We're coming back to the...
So the question you asked, because I haven't
exactly.
gotten to that
Sorry.
yet.
It's my fault now. I
I don't want
aggravated
to
the
forget.
Yes, exactly.
Because
So-
that is the human element. I want to see the
Yes.
direction of individual, and we discussed it in the previous show.
Yes.
And so when you are a free esprit or player or the soldier, I want to see how it plays in the actual scenario.
In
So
terms
go
of
ahead.
advisors,
So-
I guess that's an
Well,
interesting perspective. Yeah.
I think advisors are like everybody
Oh,
else.
of course, we're human.
It started with, the subprime crisis was the beginning of the process.
In 2007, 2008. Yeah.
I remember having lunch with a friend of mine in 2006. We were at Yonge and Eglinton in a coffee shop outside there on one of the patios, and we were reading the news, the market news, and we were saying, these houses are going up like crazy. What's going on? Like, it looks abnormal. Because if you look at the real estate prior, it was just going up. It was doubling like every 5 years. That's unheard of in real estate. Real estate is very slow moving. It's
2-3%
it tracks
maybe.
inflation
Yeah,
typically.
yeah.
But we saw this massive move for years. So we're like, something big's gonna come. But we didn't know why and we didn't know when.
Every 5 years it means 14% at least per year.
And so we said that. So that got me curious as to what's going on. So I was in the field at the time and I was reading about, the hot mortgage market and the hot housing market and this and that and the other and subprimes. Everybody was buying them. It's the thing to get into. The returns are so wonderful.
Was it part of your overall portfolio of the company that you were working with?
Subprimes, no.
Yeah.
Generally, yes, because we looked at now real estate. So this particular company, at first we handled real estate because they didn't have much of it. Then they carved a group to look only at real estate. But before that group, it would come up every so often that we'd say, we need something different. We have stocks, we have bonds, blah, blah, blah. Real estate is a little bit different. Infrastructure is a little bit different. Commodities are a little bit different. And we do studies. Is it worth to buy them? Yes, no, depends. And eventually they said, yes, it is, and they dedicated a team to it. So because of that, I got some dabbling in it, but we didn't actually execute, not the group I was in. Another group did it. But the ideas were there, and so I got into finding out what the subprimes were, what the real estate market was,
As
why
part
it
of the
was
process
going
of
up.
self-education.
And as you begin to dig, you start to find. And then you start to find the ugly stuff. So the ugly stuff of subprime is actually a giant manufactured bubble. They talk about bubbles today all the time. That one, they didn't talk about bubbles then with that terminology. But what we found was everybody was getting a mortgage. Everybody. People that didn't work, people that had nothing, people that hadn't worked for years. And they were buying $1 million homes in the States. No collateral, no assets, no jobs. They used to call them ninja loans.
Yes.
No income, no job, no
Yeah,
assets. That's the term
They
they
use
used.
that term in
And they were
in
pretty much telling you.
Was this being done by all banks, or just by the smaller banks? Or were the larger
big
banks doing this
banks.
as well?
The
Yeah.
big banks were the pioneers of this.
Like Citibank and whoever else.
JP
was-
Morgan,
yeah,
Citigroup, Goldman Sachs,
all of them were
the
doing
big
this.
U.S. banks is that were doing this, and
So-
so that's part one.
So all conventional banking practice had been essentially suspended.
yeah,
I
well,
mean, banking as we know it. Like, in other words, there was
the
no
t-
risk
the
measurement
typical
whatsoever.
bank would never ever entertain this. If you don't have a job, you're not getting a mortgage.
Oh, you have to go
Done.
through the
So the bank
application.
essentially became a speculator.
Well, it started that way, but there was more to it.
Right.
So part one was the originating the mortgages.
Yep.
So before, you had to have all these criteria, you were checked out, you had to have T4s, you had to have everything, you had to have assets, you had to have down payment. Otherwise, you're not in the game.
Yeah, you have the principal risk, you have the interest risk, you have a whole bunch of things.
And all that was
yeah,
brought in, and the bank only lent to certain people.
That's right.
The unemployed were not getting loans. The cat was not getting a loan. The guy that never owned a house before, unless he had a lot of backup, would not get a loan, etc. All these people now were getting loans. You think, well, that's just nuts.
So that was 2006 that you were sitting in coffee shop and you were saying
6 or 7, this was going
yes,
on.
okay.
Okay, now, okay, well, that's weird, but I didn't really understand the rest.
Yeah.
Then it comes up,
The syndication.
okay, well, then the value of the house came up. So the value of the house is based on appraisals. So a bank will hire an appraiser, they'll go to the property and go, yeah,
It's worth $1 million.
$1 million, done, certified by an appraiser. All right, so we can take a risk that somebody believes, we can vouch for the value. Okay, it turned out they were being paid. They were inflating the values.
Mackie and all of that, yeah.
And that's another aspect,
yeah,
was the
yeah.
home insurance.
Yeah.
And this
That was another mess.
And then Moody's and the bonds.
And then that was the next
Yeah.
mess, was the rating agencies, and that's what made it. So the banks had these mortgages that they originated. They were the originator. They knew they were shit because they looked at the lending. They go, no job, no income, no asset. This is eventually going to
So
kill
completely
us.
Any risk, essentially. Just the reality was huge risk, but with no measurement. Ultimately, it was unmeasurable risk.
Well,
in reality.
without any safety, because they were betting that the market would keep going up. As long as the market went up, there was no
But
risk.
then they got into the debt, the
once it-
swaps.
And then they took their loans and they packaged them into these weird derivative products and they sold them to everybody. This is where the institutions came in because they bought a lot of it.
Internationally.
And why did they buy this gunk? Because the rating agencies rated it AAA.
like AAG.
They rated it as good
So
as a
it's a
treasury
Ponzi
bill.
scheme. You just keep passing it on.
Well, and everybody was in it.
Yeah, it's kiting, really. Yeah, you just keep
And
passing
this
it on.
is when the interest came. I said, why are they rating this AAA? And when we started, and I was going to these conferences about, and a few of the bond managers picked it up and they said, we're not buying this stuff. Everyone's buying it, but we're not. We're absolutely, we don't believe in this, and here's why. And they spelled out what could happen.
Yeah.
And they had their own credit analysts, people that analyze these mortgages. And they looked at this ninja and they go, if that guy doesn't pay his loan, we're done.
And the thing is, even
So we're not touching him.
even a university student would even figure this one out. Like, in other words, it didn't require a sophisticated.
If you had the
Yeah,
common
yeah.
sense and you had the information, you'd look at this and go, what bank would ever do this? I wouldn't do it if I owned the bank.
But this was not as severe in Canada as it was in United States primarily, was it?
It wasn't.
Our banking
And-
system's different than theirs. Yeah.
And I attribute that we were late. Europe got hit.
You were
we
just
were
behind.
late. If it had gone on 4 more years, we
Yes,
would have been
and
into it. Now,
And what was the connection between that revelation? I mean,
okay, so this is the beginning.
Between your questioning all of these, with
Okay.
your connection with the
So,
because we are
so the
getting
so the
close.
first stage is I have to find something out
Okay.
to start questioning it. Because if I don't find something out, there's nothing to bring up.
Okay.
If everything is wonderful, there's nothing to rock. There's nothing to question. But I found there was something wrong with a big part of the system. So I began to write about this. I took this research about the appraisers, the lawyers, and there was lots of news substantiating all of it. So I wrote articles on it and I published them.
And the newspaper?
In the industry magazine.
Okay.
And it had all the sources and everything, and I did it on my own. I managed to get a connection to a publisher, to an editor, who liked it, who put it out there, and everyone in the industry saw it, including my boss.
And what year was that?
2009.
Okay, just after the...
Just after it happened, but it was still unraveling,
Okay.
because the reasons why were not really understood, or they weren't really acted
And
on.
still it was hype of who is responsible.
It was still the blame.
Yeah.
You know, sort of like right after a terrorist thing, they're trying to blame people, but you don't really know what happened until years later. It's kind of what happened with this. So I began to bring this up, and that was the first stage of, you're questioning stuff, and we're a little bit scared. This is the employer. We're a little bit scared that
Or
you're
your
bringing-
employer.
They're,
Yeah.
yeah, they
in
were
this case,
acting.
yeah.
They were acting weird. So I got their attention. Basically, I found something to talk about. I put it out there. Now they're saying, I don't know about this guy. He's asking questions that might get us in trouble. Because now they didn't have any subprimes. They had a little bit of it, but they didn't really have much exposure. But I began to ask, is anybody watching this? Because this is a big deal. We could lose a lot of money. And what do you tell your pensioners when you saw this and you didn't do anything about it?
So you were doing them the favor, actually.
Well, that's what you'd think.
They didn't see it that way.
They didn't see it that way.
I
thought I was doing my job. I
thought
thought I was doing my job by
Yeah.
saying, look, I'm out there researching, I'm out there looking at things, I'm finding these things that don't add up, and I'm giving you a warning. If we have this, we have time to get out or not get in, because it'll save us having to explain losses and having to wait for the recovery.
Like a preventive measure.
Preventative medicine. But because it's not, and now we're getting into the system, it's not what everybody else was doing. And that's why they didn't like it. And I think every industry does this. I'm talking from investments because I was there, but I think every industry does it. If you do something different, it's not good. Whatever it is, even if it's right, it's not good. People don't want it. They get scared because this person's thinking on his own, and it might conflict with what we're doing. It might make us look bad. It might threaten us somehow. We don't like it.
We don't want. To
We don't
rock
want this guy
boat.
here. You're rocking the boat.
Yeah.
And so now it got to the point of they kind of wanted to see how long it would last. Because sometimes you start rocking the boat, they kind of tap you on the wrist saying,
It's okay.
don't do it. Just
Get back to
just
rolling.
pretend that we just pretend
Tone
we didn't
it down.
hear it.
Tone it down.
Tone it down. If you continue to do it and you're not listening to them, then they get into defensive mode.
Did you get that toned down advice first?
I got the tone down advice. I got the
And-
defensive mode. But something inside of me said, you have to say something about this because there's a lot at stake. And I think all the whistleblowers will say, I did it because I was trying to make a change. I saw what was wrong with it. I did
It
the
was
work.
the right thing to do, actually.
It was the right thing to do.
Yes.
And who are you going to go to other than somebody who can make a decision and make the change? Yeah, publishing it is nice because there's awareness, but somebody who actually has the money and you can tell them, this investment is bad, stay away from it, and it saves them a whole bunch of pain later on, why not? But that's not the way they see it because the systemic influence is do what everybody else does. I don't care if it wins or loses. We have to conform. And if the conformity means it's going to be a disaster, so be it.
Because we're covered, I guess. That's the point.
Because we're covered by
As
what
lo-
the consensus is.
Is doing so. We're doing no different than anybody else.
And we can blame the industry knowledge because if the big people did it and they lost, and we did it and we lost, we did the best we
Nobody
could.
blame us already.
And I was thinking here we're getting into like change, right?
Mm-hmm.
The theme, in a way, of
Trying to
the
bring
program.
change into that.
When you're trying to bring change, the thing which is the most threatening is you're going from the known to the unknown, I think. That is the huge part here.
Well, I think for them, it's that. For the person bringing it,
Yes.
I think they have an element of, look, this subprime thing is crap. If we buy this, we're going to lose money because things are not adding up. The investment fundamentals are not there. And they talk about this with companies all the time. If something is overvalued, the shares are $1,000 and they haven't made a dime in earnings, that's usually a flag that says, that is too expensive, it's going to crash. Don't buy it. And there's always people saying this in these stock reports. And eventually they're proven right. But a lot of times, and this is more of a systemic question, but it's the same idea. If something isn't adding up, you bring it in and say, look, it's not adding up. All the theories we've learned, all the practices we have, this doesn't fit. So we shouldn't be doing it because there's more risk than we understand.
And I think it also highlights something else, which is that people have the impression that they're going to an investment house, which are full of experts,
Yes.
who are analyzing situations, and on the basis of this analysis, they are making conclusions. But in reality, what's going on, they're simply copying what everybody else is doing, and there's a kind of herd movement where, if as long as we stay in this herd movement, and so that so what then happens is that by the moment that you are calling this into question, you're forcing them to think about what they're doing. In a way, you're declaring the elephant in the room because, or in fact, worse, the emperor has no clothes.
The emperor has no clothes.
That the fact is there was no thinking going on. We were only doing this because everybody else was, and nobody wants to admit to that, because that's the last thing you can possibly admit to your clients. Well, it just seemed like the right thing to do. Why? Well, because Charlie and Bill and Bob were doing it. That is not an answer, right? But that's the reality. It's not, and so now they've got to run for cover the moment that they engage with what you're telling them.
Yeah.
And I think that's the critical thing. It's that moment, which is the path of least resistance, is then to get rid of the whistleblower.
That's easier for them.
Well,
it's easier.
Maybe
least expensive.
almost necessary, because they're so far down the road, in a way that otherwise they're going to have to literally take some of the heat from the client. They're going to have to roll back, and the client's going to say, "But this is
what you told us."
What are you doing? So that in a sense, there's a kind of it's not a lie as such, but there's a kind of an implied deceit within the whole system, is that we're experts, whereas we're not.
We are getting to the end of the program. I got signal about a couple of minutes.
Yes.
So in last few minutes, I want to focus on Joe for a couple of things. First, to clarify, at that moment when you had that tab on the shoulder, and then you don't respond favorably, they said goodbye to you, or you moved on your own?
Well, then,
because we have only
now, so the typical whistleblower, and I'm using my experience as. So now you're at odds with them. You're trying to say something, they don't want to hear it. So now you're at war, basically. They want you out, but they can't get rid of you legally, because that's not the reason to get rid of somebody, that I don't like what he said, and maybe he's telling us a good thing, so I fired him. What they're going to try to do is get you to leave. So they make it miserable for you.
So the conditions.
So the war escalates. The conditions get worse. If you don't go voluntarily, the situation gets worse. Or now you become targeted for
by everybody,
blame by whoever can do it.
Yeah.
And then it gets to the point, it might end up in a lawsuit, it might end up in defamation, it might end up in slander, it might end up in a settlement, it might end up in, okay, you win, I'm out. Where the person gets to a point of they can't take the heat and they leave. But any of those things can happen, and then the whistleblower may go public. Once they're done, they say, well, that ordeal is done, but that truth is still there. And then you have other risks. And the choice then is, do I want to keep a job in this industry?
Yeah, of course.
If yes,
because now if
you're
you
still
are
under-
stamped,
Once you're branded a whistleblower, you're done.
you're done with
You're
the
done
big companies.
completely
So you
done.
have-
Nobody hires. There's no specific job description whistleblower.
yeah, you cannot
Or,
put it. you can-
maybe we'll have to create one.
Yeah.
Maybe that wouldn't be a
Well,
bad one.
Yeah.
But in the world thus far,
Yeah.
there it doesn't seem to be.
So there's a personal choice in saying, I need to make a change, period. Not just change jobs, but do I want to have this career or not? And I think that's why a lot of people don't do it.
So you left on your own in this case, or
I left with a settlement.
with the settlement? Okay.
So I fought them part way. I got to a point, and then I said,
Okay, that
I've
is-
proven my point. That's it.
we are at the end of the show. Okay, in the last minute, we have only 1 minute left. Can you tell to our audience that how they can in touch with you if they need to have their money, their business, if they want their
Your
Contact?
end of show pitch
Yeah, yes,
stuff.
It
Well-
is your moment of the after all of this whole
Of this gauntlet.
whole shebang and decoration.
Now
so
that
we
you've
want people to
destroyed
know
your credibility
who they
altogether.
are. You have now you have your own credibility as a whistleblower. So now no big company wants you, but people still they have money that they want to invest. Who should they contact you? They
They
should
have
contact you
shelters out
directly.
there and things like that.
Yeah.
Well, it's
In the pocket, you said.
it's very simple. joeltheinvestor.ca.
Okay.
That's my website.
Okay.
There's a contact us page
Okay.
that has a cell phone number, email.
Okay.
There's a lot of things on the site.
You have all sort of the gamuts of anywhere between $50,000, let's say I'm just using that number arbitrarily, to $50 million or whatever.
There's no asset limit. There's
Okay.
no preconditions.
So we have to talk after the show.
I,
I don't
uh,
have money. I want money.
Yes. So fee only is by it's a flat fee by the work done.
Okay.
So that's why there's no
So
assets.
they know at the beginning how much
They
they,
know
are
at the
going
beginning.
to pay or going to pay, and there is no residual commission.
No.
Okay.
So
You're
yeah,
the antidote, in a
Yeah.
sense, to everything that we're talking about.
I'm trying
Probably
to
we
bring a
need more
change that
people
way.
like him.
Absolutely. No, certainly we do.
Do you have any last word, John?
No, not at all. Thank you very
Okay.
much for coming.
Yeah.
Thank you, John. John, thank you for the
Bob.
line of questioning. Joe, thank you for being our first guest, and hopefully we will have you again in coming months to update the situation for different aspects of it. Now that we know what is your base is, now we have to build on it. What's happened now in the last 5-6 years?
Yeah.
Ladies and gentlemen, thank you for being with us this Tuesday. What is that? We are November 17 of the 2015, very close to the end of the year. And again, you can now, we have a basic website called turnaroundduo.com that you can go and get some basic information and contact information. If you need someone to come and evaluate your organization, you can contact John at johnberling@gmail.com or myself, Bahman@canaglobe.ca. Both of them are available at the end of the show as well as our website. Thank you and good night.